I welcome today's learned speaker, past president ICAI, R. Bupathy. Topic for the today's webinar is clause by clause analysis of finance bill. Thank you, CAR Bupathy, for accepting our invitation, for sharing your vast knowledge and experience in the field. I also thank you, CA Sanju Maheshwari, past Central Council member, for coordinating with the speaker and getting the speaker to Nagar Study Circle webinar. I now request CA Jayesh Shah, past convener and core group member, to introduce CR Bupathy formally. Thank you.
Good morning to all. Thank you, Simaji, for giving me this opportunity. We have with us towering personality of our profession, Sri R. Bupathy, past president of our institute, to give the insight on the subject. We are fortunate to have with us for today, and it is due to this virtual meeting we are able to have a word with him, and we are fortunate to have at least on board and to share his views on the subject. I'll just try to introduce sir with a brief. It will take long time to if you have to introduce him correctly, but I'll just try to make it very brief. R. Bupathy is a founder partner of Bupathy and Company since 1970. It is a firm based at Chennai and established in the year 1976. Firm has its affiliates in UAE with a firm called SPA Auditing as a networking partner. So, sir has served on various institutions as advisors. He has served as a Central Council member for 9 years, and we were fortunate to have him as a president of our institute during the year 2003-2004. He has served as a committee member of apex body of accountant called International Federation of Accountant for the year 2000 during the year 2003 to 2006. He has also served as a chairman of International Fiscal Association of India branch during the year 2006-2008. He is also presently a chairman of a company in the name of Geojit Financial Services Limited. He is also presently serving on various companies as an independent director. He is a recipient of various awards, name a few: Paramchari Award, Confederation of Asia Pacific Accountants Award. With this brief, I request sir to take us through the subject.
Thank you very much, Seema and Jayesha, for the kind words of introduction. CA Krishna Kumar, Deputy Convener, and all the other committee members of JB Nagar CP Study Circle. What a very pleasant Sunday morning for all of us. I'm indeed thrilled to be part of the study circle, which I know is formed in the year 1999 and has got more than 1,700 members. And it's quite interesting to read that it has received the Best Study Circle Award for 16 years. The ability to sustain that award for 16 years is something exceptional. I'm indeed very happy to be present here to share this virtual media platform with all of you and share my thoughts on a very interesting and important subject like the analysis of the union budget. Direct taxes, you all know, has to be used to direct the economy in the manner in which they want to do it. They have laid down some priorities. They list down some criteria, challenges ahead before the government, and they want to divert the funds to those areas. So tax will be, incentives will be given, concessions will be given to lure these people to those areas. Therefore, discussing this is very, very important, significant for the people at large, and particularly for the CA profession. What I have done is, the PowerPoint presentation which I made is nothing big. It's a very simple presentation wherein I have listed out the important changes made in the finance bill. Just a list of it. Each one I will take and try to explain that in detail once I share the screen. Also, I have arranged it in such a manner that what I consider important, I put it in the first part and gradually tapered it off, so that the important ones we could discuss when we are fresh and when the law of diminishing utility has not begun to work on us. So let me, with this brief introduction, share the screen with all of you, and thereafterwards I will take each item one by one only will come, and we will share each item which appears on the screen. First one I would like to speak, first amendment which I would like to see is the leave travel concession. This is a very unique amendment because it is applicable only for the assessment year 21-22, and this has come into existence to get over the difficult situation of this pandemic. The expenditure pattern of people has reduced because of the pandemic, and in order to attract people to incur expenditure, they have given this concession, which is, to my mind, a good concession. Whatever LTA you have received from your employer, in a block of, they are given about 5 conditions to get this benefit. What are these conditions? You could incur some expenditure. You get an allowance and you incur some expenditure. These expenditures should be subject to GST, a minimum GST of 12%. It could be more than that, GST of 12%. Either goods or services. And you have to incur this to a specified vendor, GST registered vendor, and it should be through the banking channels. But more importantly, the expenditure should be incurred during the period 12th June 2020 to 31st March 2021. And the maximum amount which will be allowed, will be eligible for exemption, very important, is 36,000 per member, 36,000 per member, or 1/3 of the expenditure incurred, whichever is less. That 36,000 per member or 1/3 of the expenditure, whichever is less, is the exemption you could claim. This is the simple provision which has been introduced. Yesterday, I received a question from one Mr. CA Ashok Sundrani. He has asked me a very specific question, saying that for the block of 4 years, 2018 to 2021, an employee has availed leave for once, and he has availed the leave travel concession. He is availing the leave now, he is availing this concession now and incurring the expenditure. Will he be eligible for this exemption of 36,000 per member? My understanding of the provision is that yes, he will be eligible, because the section very clearly says in this block of 18 to 21, if you incur expenditure on these items, that is expenditure which are subject to GST, you will be eligible for this exemption. So this is a very important amendment, and it's applicable only for the assessment year 21-22. Now we will move on to the next item which I have put. You will find here denial of depreciation on goodwill. Now this has been engaging the attention of the profession. The matter has gone up to the Supreme Court, and the Supreme Court has held in a case known as Smith Securities, SMIFF, Smith Securities, has held that goodwill is an asset and depreciation can be claimed. I draw your attention to the wordings in section. Slowly, I will tell the wordings in the section. In 32 clause 1, they use the expression tangible assets or intangible assets. Depreciation can be claimed on tangible or intangible assets. Explanation 3 to section 32 defines intangible assets as know-how, patent, copyright, licenses, franchises, commercial right, or any property of similar nature. There's a definition. Block of assets in section 211 also defines it, but in none of these three provisions, the expression goodwill has been mentioned. It's only an interpretation saying that it is an intangible asset and you are entitled for depreciation. That is the view of the Supreme Court in Smith Securities case. It's interesting to read the memorandum explaining the finance bill. There they have explained that there are so many other clauses in section 32 dealing with depreciation, which gives us an indication that depreciation cannot be claimed on goodwill. And they have very nicely narrated it in the memorandum explaining the Finance Bill 2021. If you refer to the sixth proviso to section 32, wherein they say, if there is an amalgamation or merger of a company, then the depreciation for the entire year, during the year there is an amalgamation merger, depreciation for the entire year shall be calculated as if no amalgamation has taken place, and the depreciation arrived at shall be apportioned between the amalgamating company and the amalgamated company on time basis. That means if there is any addition of goodwill, that should not be recognized. Therefore, any asset will not be recognized. Similarly, in the definition of WDV under 43(6), it says that the WDV at the beginning of the year add cost of additions made during the year to that block. And the definition of cost is given in 43(1), and explanation 7 to 43(1) says you must take the cost to the previous owner. You must take the cost. In other words, cost to the amalgamating company. In all these situations, reading all these two together, the indication which we are getting is that depreciation cannot be claimed on goodwill. And the memorandum explaining the bill makes one small statement saying that depreciation cannot be normally envisaged on goodwill, and hence they are attempting to, they have made some amendments in this finance bill to deny depreciation for all of us. What are the amendments they made? They made an amendment in section 211 to subclause 11, wherein they have said that the intangible assets will specifically exclude goodwill on business or profession. And in 32(1)(2) also, they are very specifically excluded intangible asset, excluding goodwill on business or profession. Now, what is interesting and important here is that in section 50 of the Income Tax Act, that is for the purpose of computing capital gain on the sale of a depreciable asset, which is forming part of a block of assets, what they have done is, if the block of assets includes goodwill on which depreciation has been claimed in the earlier years, then if you want to compute short-term capital gain, because on depreciable asset, whatever gain you get will be a short-term capital gain. Short-term capital gain or the depreciation on the WD of the block shall be calculated as per a method to be prescribed. It is not prescribed as such. Now, 2 or 3 things which is emerging over the last 2-3 budgets is that these type of power to issue clarifications, guidelines, and prescription is increasing. Therefore, more such clarifications will keep trickling on and off for us, and we have to keep our antennas pulled up to understand those things. So the capital gain on depreciable assets, if the block includes goodwill on which you have claimed depreciation, then the capital gain arising will be computed as per a method to be prescribed, which is not yet known as on date. If the goodwill is not forming part of a block of assets, and if it is sold directly, if it's held as an independent asset, then Section 55 of the Income Tax Act, which deals with cost of asset for the purpose of computing capital gain, where they said goodwill is the original cost of the goodwill minus the depreciation which has been claimed and allowed will be treated as the cost, and it will be taken for the purpose of computing capital gains. So the Finance Bill 2021 has made the necessary amendments to deny depreciation on goodwill, acquired goodwill. If you pay money and buy goodwill also, you will not be eligible for depreciation with effect from this assessment year onwards, 21-22 onwards. Having explained this, this is the second point we considered. We now move to the third point. Applicability of Section 43B on employees' contribution to Provident Fund. Now you'll sign here, I'll tell you the little bit of background. Employees' contribution to Provident Fund, Staff Welfare Fund, or Superannuation Fund, by no stretch of imagination, can be considered as income of the company. The employer collects it and remits it. It's the role of a post office. It's an intermediary. So it cannot be considered as income. But under the income tax law, by a deeming friction, in Section 2, subclause 10 of the 224 subclause 10 of the Income Tax Act, wherein they have said employees' contribution will be treated as income. And 36(1)(5)(a) says that employees' contribution to Provident Fund, Staff Welfare Fund, Superannuation Fund will be allowed as deduction if it is paid before the due date prescribed under the relevant law. Whatever is the due date, if you pay it within that due date, it is eligible for deduction. Now, the employer's contribution, the employer makes a contribution to the Provident Fund, Superannuation Fund. It is allowed as a deduction. And by virtue of 43B of the Income Tax Act, you may make a provision for it. It will be allowed as a deduction if it is paid before the due date for filing of returns. So, the treatment for employers' contribution to Provident Fund, Superannuation Fund, Staff Welfare Fund is, it is sufficient compliance of law if you pay it before the due date for filing of return under 139(1). But as far as the employees' contribution to Provident Fund, they have said it should be paid before the due date prescribed under the relevant law. Some courts have interpreted and given a view that even the employee's contribution can be paid before the due date for filing of return under 139(1). And the Finance Bill 2021 firmly states there is a difference between employee's contribution and employer's contribution. Employer's contribution is the money belonging to the employer. Employee's contribution is the employer collects it from the employees, and if it is not remitting it, it's a more serious offense, or it's a more serious issue, and hence it should be paid before the due date prescribed under the relevant law. And there has to be a distinction, and they've inserted an explanation to 36(1)(5)(a), wherein they said 43B will not apply to employees' contribution to Provident Fund. So employees' contribution to Provident Fund has to be paid before the due date prescribed under the relevant law. They amended 36.5, 36.15, and they also added an explanation 5 to 43B, wherein they said 43B will not apply, deemed never to be applied for employees' contribution. So the way the explanation is drafted is quite important to note. Does not apply or deemed never to have been applied. In both the sections, they have used the same. Therefore, the question of whether this is but this these two explanations are introduced from this year only, from 21-22 only. The issue is never to be applied. Does it have a retrospective effect? Is something which we have to debate. So this is the third amendment which I have explained. Interest on employees' contribution to Provident Fund. Now, what is happening here? What is happening here is very, very significant. Employees have to contribute to the Provident Fund, and it is covered in section 1011 and 1012 of the Income Tax Act. Any Provident Fund to which the PF Act of 1925 applies, or any notified Provident Fund, if the contribution is made to such a Provident Fund, and if the employee is going to withdraw the Provident Fund at the time of either termination or retirement, then it is totally exempted from tax, including the interest on it. So when the employer makes a contribution, the employee makes a contribution, the interest on the total balance is completely exempted. Now it is possible that people with higher income, higher salary income, are able to contribute voluntarily more to the Provident Fund, and they get a huge income. If that is the case, now you are helping the rich to become richer. Hence, they have said any employee's contribution in excess of 2.5 lakhs per annum, in excess of 2.5 lakhs per annum, interest on the excess over 2.5 lakhs will not qualify for the deduction under section 1011 or 1012 of the Income Tax Act. Will not qualify. This is what they have mentioned. Up to 2.5 lakhs is permitted. It is here I would like to modulate my voice and draw your attention to a news item which appeared in the paper, wherein they have said one individual in our country has accumulated as much as 103 crores in his Provident Fund. 103 crores in Provident Fund, and if he's going to get interest on that, which is totally tax-free. Another important statistics they've given, 3 persons have, each one of them have got 86 crores, and another 20 persons have got 825 crores. This really substantiates the need for an amendment of this type. If they are going to contribute about 2.5 lakhs per annum, the interest on the excess over 2.5 lakhs will be the exemption at 1011 and 1012 will not apply, and it will be chargeable to tax. But one small clarification, technical clarification. They have not said 2.5 lakhs. They use the expression 2.5 lakhs contribution, or in the aggregate 2.5 lakhs. Aggregate 2.5 lakhs. So if you contribute to a Provident Fund and the public Provident Fund, together which crosses 2.5 lakhs, how they are monitoring it, how they'll implement it, is that's why they put a clause in the same section saying that where some difficulties arise, the government will give, the board will give some guidelines. So this is, and there could be withdrawals by the employees also. In that case, how they will consider this withdrawal out of the excess over 2.5 lakhs or from the 2.5 lakhs. These are things which they have to settle. Right now, if the contribution is about 2.5 lakhs, interest on the excess over 2.5 lakhs will be the exemption on 1011 and 1012 will not apply. So this is the second amendment. So Having explained this third part of it, or the fourth amendment, the fifth amendment is amount received on redemption of unit-linked insurance plan. I need not explain to this group that unit-linked insurance policy has got two elements. One, an insurance element. Second one, an investment element. Now, if you are paying only insurance premium, that's a different issue. But when it's a composite instrument, composite investment, they don't want to give the exemption in respect of the investment part of it. And they also want to take care of the small timer. And therefore, they have said, if the premium is up to 2.5 lakhs rupees, then any amount which you receive on the redemption of unit-linked insurance policy will be exempted. If the premium exceeds 2.5 lakhs, then only the issue comes. How this amendment has been done? They amended the 214 capital asset definition, and they said unit-linked insurance policy will be considered as a capital asset. They brought it within the definition of capital asset. They introduced a proviso, particularly the fourth proviso to section 1010D, the fourth proviso, and very clearly they are mentioned in respect of a unit-linked insurance policy taken on or after 1st April 2021. 1st April 2000. So the policy which are already taken are not hit by this amendment. It is only prospective. In respect of unit-linked insurance policy taken after 1st April 21, and the premium exceeds 2.5 lakhs, then the maturity amount, to the extent it pertains to the premium in excess of 2.5 lakhs, will not be eligible for the exemption under 1010D of the Income Tax Act. This is the fourth proviso. The fifth proviso is if you have more than one policy, more than an aggregate premium for all the policies should not exceed 2.5 lakhs. The premium paid for all the policies put together should not exceed 2.5 lakhs. And the premium paid on the policy up to 2.5 lakhs will be eligible for exemption. Anything above that will not be eligible. There's also another clarification which they have said, in case of death of an individual and the policy amount is withdrawn by the legal heirs, then this exemption will continue to apply, and the denial of exemption will not be valid. He will, even if the premium exceeds 2.5 lakhs rupees, the entire amount will qualify for exemption. They said nothing in these provisos will not apply in case the amount is received on death of an individual. Finally, on the amount received on redemption of unit-linked insurance policy, it is chargeable to tax under which head? They have said it is chargeable to tax under head capital gains. They amended the definition of equity-oriented mutual. It will be treated as 112A, income on 112A as equity-oriented mutual funds, and any income above 1 lakh, there also, all long-term capital gains, and this income overall 1 lakh. If you receive more than 1 lakh, on the excess over 1 lakh, you have to pay tax at the rate of 10%. So the amendments to charge the amount received on redemption of unit-linked insurance policy is done in this fashion. And here also they have mentioned, in case of any difficulty, the government could come out with certain clarification guidelines for them to calculate the amount which is the redemption amount which is equivalent to the premium in excess of 2.5 lakhs. If there is any difficulty in calculating this amount, they will come out with suitable guidelines. So this is the fifth amendment I listed out. And the next one is amendments relating to charitable trust. I think the all the regulators are not charitable towards charitable trust. The compliances of all charitable trusts is increasing and increasing very steeply. People who are enthused to do some charitable activities will take 2 steps backwards if they look into all these procedural compliance. You need experts. In fact, one of the charitable institutions where we had to handle the this CEO or the person in charge of the charitable trust was paid a handsome salary. The officer questioned it. What's the need for paying such a fabulous salary to an executive of a charitable trust? But the responsibilities and the time which he spends for administering the trust and the various compliance requirements are increasing on day-to-day basis, that unless you are able to sustain the interest of those people, they have a family to take care of, they have children to educate, they have medical expenses, unless we give them, we cannot retain them. Therefore, we have to substantiate that way, but still the department is not very comfortable paying very high salary to executives of charitable trust. At the same time, the responsibilities are increasing. Now, amendments relating to charitable trust, 3 amendments have been made. The first one is regarding corpus contribution. I will explain it in very simple terms like this. A charitable trust receives 1 crore towards corpus trust. Another 1 crore as voluntary contributions. 1 crore as corpus and 1 crore as voluntary contributions. It has to apply 85% of the voluntary contributions for the objects of the trust. Then only it will be eligible for exemption. Now, it incurs some expenditure out of the corpus of the trust. According to the directions, it's used. That amount which they spend from the corpus of the trust, they equate it to 85% applied from the voluntary contributions. And out of 2 crores, they have spent 85 lakhs from the corpus. From the voluntary contributions, they have not spent any. And they say, yes, we have spent 85% of 1 crore. And the entire 2 crores, they are claiming exemption. This is one aspect which the finance bill starts to attempts to stop. The second one is they take some loans. A charitable trust takes a loan. And from the loan, they incur it for the objects of the trust. And they claim 85%. 85% is spent and they claim it as an application. Okay. So from the loan, they have spent it for the objects of the trust. They treat it as 85% application. And next year or the year after that, they mobilize some resources and repay the loan. The repayment of the loan also, they take it as application. So one expenditure is treated as an expenditure twice. It's treated as an application twice. These two also, they wanted to stop. So in these 2 amendments, they have said, if you are going to spend any money from the corpus of the trust, that will not be considered as an application. That will not be considered as an application. You cannot treat it as an application for the purpose of complying with 85% of the income should be applied. Similarly, if you take a loan and if you are from the loan, if you are making an application for the objects of the trust, that will not be considered as an application. However, they are given some, they had the correct thought process. Assuming from the corpus of the trust, you have spent it for the objects of the trust. Subsequently, you recover it again, put it back to the corpus. When you put it back to the corpus in investments, specified investments, and relate it to the corpus, then what will happen is it will be treated as an application of that year. In other words, instead of treating it as an application twice, it will be treated as an application only once. Both the things they have said. Third amendment, as far as charitable trust is concerned, they very clearly said, assuming the earlier years we have incurred some expenditure and the expenditure is in excess of the income, and that excess expenditure, we cannot treat it as an application of the subsequent year. These three amendments have been brought about in the charitable trust. Practically, this will create a lot of problems, because if you collect a corpus contribution, you have to put it in a notified investment, 11(5) investments. If you put it in specified investments, okay, it's all right. And from there, if you take it and spend it for the objects, it will not be treated as an application. Again, when you collect it and put it back in 11(5), it will be treated as an application. So to track this, to treat it as to relate it on a one-to-one basis, to satisfy the department officers that it has been done in this fashion is going to be a challenging thing, and any type of software should be developed to monitor this and convince the authorities. This is the third amendment. The fourth amendment, all these amendments, not only charitable trusts, it's also applicable to institutions which are eligible under 1023C of the Income Tax Act. In 1023C, there is one more specific amendment. Now, we have 1023C specifically for college, university, or education institution. This is one category. The other category is hospital, medical institution. These two categories are there under 1023C. Now you will find those relevant clauses under 1023C can be categorized into three types. What are the three types? Type number one, institutions which are substantially financed by the government. They are completely exempted. They are not subject to any conditions, which are substantially financed by the government. Second, I give this name. It is not there in the Income Tax Act. I give this name as small institutions, wherein they said if the gross receipts from these institutions, either a college, education institution, or a university, or a hospital or medical institution, if the gross receipts do not exceed 1 crore, presently it is 1 crore. Presently it is 1 crore, and what they have attempted to do and what they have done is, if this monetary limit of 1 crore, they have increased it to 5 crores. That means if your gross receipts of an education institution or a university, hospital or medical institution, if it gross receipts is up to 5 crores, they are not subject to any restrictions of applying the money within 85% during the year. All these restrictions are not applicable. The third is the others category. So first category is substantially financed by the government. The income tax department is not very concerned about it. Second is the small institutions where the turnover is up to gross receipts up to 5 crores. They're not interested in it. The third others category is subject to all the conditions mentioned under 1023C of the Income Tax Act. Hope I made myself clear on this point as far as 1023C is concerned. With this, the first slide I have completed. Now I go into the second slide. What is this message coming? Please move this window away. What is away from? Okay. Now I will go to the NRIs, amendments relating to non-resident. Here I would request your full concentration and attention. Finance Act 2020. 1st of February 2020, the definition of residential status was amended. What did they say? In the case of an Indian citizen who is having a total income in India exceeding 15 lakhs, excluding the income from foreign sources, okay, shall be deemed to be a resident of India, shall, irrespective of the number of days. 6(1)(a) begins by saying, notwithstanding anything contained in 6(1) of the Income Tax Act, shall be deemed to be a resident of India if his income is not liable for tax in any country. His income is not liable for tax in any country by reason of his domicile, residence, or any other criteria. And as soon as this provision was introduced in the bill on 1st February 2020, last year, the reactions in the GCC countries was heard in India. It was quite vociferous. Those people are there and they are Indian citizens. Their income, most of them may have some income in India exceeding 15 lakhs, excluding the income from foreign sources. And they are not paying tax. They are not liable for tax in GCC countries. They will automatically be treated as a resident of India. And if they are treated as a resident of India, the global income will be subject to tax. This was the fear. Genuine fear, legitimate fear. Therefore, the correction came that these type of people who are deemed to be residents under Section 6(1)(a) of the Income Tax Act will be considered as a not ordinarily resident. If they are considered as a not ordinary resident under Section 6(6) of the Income Tax Act, then the global income is not chargeable to tax. The income outside India will be included in the total income only when the income arises from a business controlled from India or a profession set up in India. The other global income will not be charged to tax. So they got the benefit relief and they kept quiet. Once again, I draw your attention to 6(1)(a). Indian citizen who is, total income exceeds 15 lakhs and is not liable for tax, in any country. Now, when do you say a person is liable for tax in any country or not liable for tax? There is some ambiguity there. Now, people started extending an argument that GCC countries, it's not that they are not liable for tax. The government had the right to levy the tax. They had the right to levy the tax, but they have decided not to levy the tax. Therefore, it is not liable for tax. It is for liable for tax and it is exempted. So you cannot say it is not liable for tax. This is the argument they extended. And that is why in this budget, Finance Bill 2021, in the Finance Bill 2021, they added clause 29A to section 2. Section 2, 29A has been added. And I will just read out that small explanation for this clause for you. There is a liability tax under any law in any country. The liability to tax must arise because of a law in a country. The law should say it is liable for tax. And then subsequently is exempted, it's okay. Then you could say it is liable for tax. But if there is no law levying tax at all, then you cannot say it is liable for tax. There is no tax there, and this, 6(1)(a) will get triggered. So this is a very important amendment. Those people, Indian citizens who are outside India, particularly in the GCC countries, and having 15 lakhs income in India, if they have a business there in the GCC countries, and if that business is controlled from India, then that business income would be included in the total income. If it is not controlled from India or the income does not arise from a profession set up in India, they really need not be concerned. But the amendment is the introduction of 229A, which defines what is tax payable in any country. The tax, for example, I would like to share with you, in Singapore, if you get some capital gains, it is included in the income, exempted by your provision. If it is exempted by your provision, then it is liable for tax in Singapore, and specifically they are given exempted. But if there is no law at all levying tax on capital gains, or no income tax law at all, then you cannot say it is liable for tax. So this is also another very significant amendment which we have to note. This is the definition of liable to tax under section 229A, which has been introduced. 1023 FE. Before we commence the proceedings, I was asked, Mr. Jayesh Shah, the convener, was asking me a question. How do you see this budget? Now, if you read the finance minister's speech, the allocation they are given for infrastructure is very, very huge. I'm not going to figures. In a morning like this, in a virtual meeting, in a home comfort, if I give too many numbers, you got the option, and nobody will know whether you are listening or not listening also. Therefore, I don't want to bore you with numbers. These numbers are easily verifiable. They have given a sizable allocation. They have to mobilize funds for it. So what's happening here is 1023 FE is an income section which gives exemption. Now, what is important here is who could gain this exemption? You see, macro level, you have to understand. Outside India, we have people, huge funds, having a lot of resources, lot of money, and their return of investment is not very high. In India, we need money and the cost of finance is very high. So the government understands this, would like to attract these institutions having large funds by giving them a tax break here in India, by giving them a tax. And what they have done in this finance bill is something which we have to note. What are the institutions? Specified institutions. The first one is known as Abu Dhabi Investment Authority of India, ADIA. Abu Dhabi Authority of Investment Authority of India. Huge funds they have. Second one is a sovereign wealth fund, a wealth fund of a country, sovereign wealth fund. And third one is pension funds of large organizations. They have resources. The return of investment is not very high. So what the government has done is, these institutions, these three institutions that I told you, can invest in infrastructure companies, and they have to invest 100% in such infrastructure. The present law says you must invest 100%. 100% of the infrastructure company should be invested by these funds, or they should invest 100% in category 1, 2 alternative investment fund. These are the two institutions which were available for them. But in this finance bill, they have become very practical, and the need to attract funds is more urgent for us. We cannot wait for a long time. Therefore, they said, instead of investing 100% in infrastructure project, it is sufficient compliance if we invest 50%. So the minimum investment in infrastructure company has been brought down to 50%, because the balance could be mobilized from India also if you require it. So to that extent, it makes things a little more easier. They could also invest in investment in infrastructure, investment trust is permitted. They added one more thing. Now this created a very practical problem. Those of you who deal with large corporates, we will understand a sovereign fund or a pension fund cannot invest in multiple infrastructure companies. If they want to invest in multiple infrastructure companies, they have to monitor, they have to keep track of multiple investment, infrastructure companies. Very difficult. So what they wanted to have is, they wanted to float a company, one company in India, make this as the holding company, invest in the holding company, and the holding company in turn will invest in various infrastructure projects. In other words, the sovereign fund or the pension fund or the ADIA will invest only in one company in India, and that company in turn will invest in infrastructure projects. Hope I'm making myself clear on this point. It makes things easier for these funds. You make it easier and they will bring the investments to us. So, and they said this holding company can invest has to invest minimum 75% in infrastructure companies. because you give it to holding company and the holding company has to invest 75% minimum in infrastructure. You could also, holding company can also give money to the industry, investment in infrastructure finance company or infrastructure debt funds. But one thing they have done, in case you are not investing 100%, you are investing only 75% or 90%, then the exemption which is available to the non-resident is only the proportionate income. The income of this infrastructure company, 75% of the income only will be eligible for exemption and not. So proportionate exemption they are entitled for. So this, to my mind, will accelerate, will hasten the flow of money into infrastructure, and the government can, to a certain extent, achieve. Similarly, I would like to tell, incidentally, I will take also another amendment connected with this. 1,75,000 crores they want to mobilize by disinvestment. 1,75,000 crores. They have lined up some public sector companies, two privatization of 2 banks, and 1 general insurance company. They want to give some money for this. Now, this investment, is it possible to mobilize? That's why they amended 72A also. And wherein they said, and the definition of demerger, if you are going to demerge a unit of a public sector undertaking, if you want to get the benefit of demerging provisions and carry over the losses, the conditions laid down as defined in the definition of demerger in 219AA of the Income Tax Act is very strict. Now what they have said is, these type of institutions, if they comply with the conditions to be notified by the government, that is sufficient compliance, and they could get the benefit of carryover of losses. In other words, in order, today is a necessity. We must get all these things. If we don't get this, the fiscal deficit will swallow us. Already it's very steep. Even this, the fiscal deficit, economists feel it's very bad for the country. If you don't mobilize this from the disinvestment and this fiscal deficit at the end of the year goes up further, then what will happen is we are in for more serious trouble. So government has rightly sensitized these people, and they would like to mobilize more money. So this is, next one is section 9A. I do not know at the grassroots level, if you are practicing as a chartered accountant, these sections may not be very, very relevant. Therefore, I'm not planning to spend more time, but I will briefly explain this section 9A for you. 9A is an eligible fund, okay, fund management activity. There's a fund outside India. And one of the conditions for this fund is 95% of the investment in funds must be by non-residents of India. And there should be minimum 25 members. And 25 members, non-resident, they should invest 95%. The balance 5% can come from residents in India. And this fund will do some investment activities in India. And for which, to manage this fund, they will have a fund manager in India. Now, mind you, if an employee of the foreign company, of the foreign fund, is going to be based here in India and is going to manage the funds, now you will trigger the definition of business connection in India, and whatever income the income they get from the investments in India will be deemed to accrue arise in India, and it will be chargeable to tax for the fund there. Therefore, 9A very nicely provides that such type of funds which are mobilizing funds from non-residents of India, and if they are going to invest in say some activities here, it will not, and the fund manager is going to do it in India, the presence of fund manager will not be considered as a business connection. 9A very specifically says it will not be treated as a business connection, and thereby the profits from the investments in India will not be deemed to accrue arise in India for the fund outside India, and it will be exempted. And they gave in a big list of conditions there, big list of conditions. And if these conditions are to be complied with, now it's going to take a long time. So in this act, in this finance bill, 8A, a clause 8A has been added to section 9A. wherein they said, by notification, provide conditions shall not apply. The conditions listed out in section 9A will not apply or will apply with modifications for the investment fund. In other words, they are diluting these standards. So these are things which I would like to mention. And now, considering the time which is available at our disposal, I will now move over to the other things. 10.4D also is similar things to attract non-residents they have done. And 10.4F is leasing of aircrafts, royalty received by a non-resident for leasing aircrafts to a unit in the IFSC, International Financial Service Center. And the unit in the IFSC is going to pay the lease rent, loyalty for leasing an aircraft. For the non-resident, it will not be chargeable to tax. Again, the government has recognized that because of the pandemic, the air travel has industry has taken a beating. In order to revive that, they are giving these concessions, and it will be allowed as a deduction for the unit in India, but it will not be treated as income for the person who receives it. So this is and TDS on payment to FIIs, foreign institutional investors. See, all these things I captured it under heading non-residents, and they are going to contribute a substantial amount for our infrastructure. All these concessions cumulatively, to my mind, will definitely generate enough funds for our infrastructure activities. Hope I'm making myself clear. Yeah. Can I get a small feedback that whether the speed as well as the voice at which I'm speaking is audible? Anybody who could respond?
Yes, it is audible, and it has a lot of clarity also. There is no problem.
Okay, I'll continue then. See, what happens here is the foreign institutional investors, when they get some dividend income or any income here, they are charged to tax at the flat rate. They are charged to tax at the flat rate under 115 AD of the income tax. Whereas if they are paid some other income, now the TDS provisions on that will be either the rates in force, not for these FIIs, for others when they make payment to any other non-resident, it will be deducted at the rates in force. Rates in force has been defined to say the rates of tax applicable in the Income Tax Act, or if the rate in the double taxation avoidance agreement is beneficial to the assessee, then the assessee could claim that, and the person making the payment could deduct taxes at the lower rate, either the rate in the Income Tax Act or the rates prescribed in the DTA, whichever is favorable to you. But for FIIs, it was not there. FIIs, if it's a flat rate, even if the DTA says lesser than the flat rate, the organizations have to deduct tax at a higher rate. Now, in this finance bill, they have made it, they amended the section 196D, and they have said, even when you are paying a flat rate to the foreign institutional investor, and in case the DTA provides a lesser rate than the flat rate, then the persons who are responsible for making payment of the income can deduct tax at source at the lower rate. And to this extent, the cash flow of the foreign institutional investors will improve, and is definitely beneficial. All these things, I would say, is a package to attract the investments from non-residents for our infrastructure projects. I would definitely say these are all amendments in the right direction. Now we'll come to the other thing, an assessment procedure. There are very small amendments which have been made on assessment procedure, and only thing is which requires concentration from our side is the reassessment part of it, where I will focus upon now. The first one is time limit for filing belated return and revised return. The file has been three things. The time limit has been reduced by 3 months. Normally, in 139.4, before the end of the relevant assessment year, you have to file it. They reduced it by 3 months. Revised return, they reduced it by 3 months. and intimation under 143(1), they have to pass, and they have reduced it by 3 months. In other words, they are accelerating the process of the completion of assessments. Time limit for filing of return of partner firm being subject to transfer pricing audit. Now, if a firm is subject to transfer pricing audit, the firm has got time up to 30th November. Now, if you ask the partner to pay ahead of it, it's difficult. The partner's income depends upon the computation of firm's income. So they have extended it till that date. Fair enough. Defective return, exceptions to be given by notification. They are given clauses A to M when the assessment will be, return will be considered defective. If it is considered defective, there are no exceptions right now. There are very many difficulties where the department simply treats a defective return and sends it back to you. Now, by notification, they could say a particular class of persons, even though they have not complied with the requirements, it will not be considered as a defect. They can give an exception by notifications. These are all simple amendments. Therefore, I'm just listing it out and telling you. Adjustments in 143(1). Here you note, I am reducing my speed. I am drawing your attention. I'm requesting you to concentrate, shift in your seats, relax, listen to me. If there is an observation in the tax audit report, the present adjustment is that if the tax auditor has mentioned in his Form 3CD, a particular expenditure has not complied with the requirement of section and he has put the amount, the department will check in the computation whether the disallowance has been made. If the disallowance is not made, then they could add it at the time of sending the adjustments. This is the present law. What they have tried to do in this finance bill, and they successfully done it, is that if the tax auditor in his tax audit report has mentioned a specified income which ought to have been taxed, has not been subjected to tax. If there is an observation like this in the tax audit report, particularly after the income tax standards have been introduced, there could be situations where, as per the standards, some income is not disclosed in the income tax return. So if an tax auditor is going to make some observations like this, then the amendment has been made. They could give disallowance to expenditure and they could add some income which has been specifically mentioned in the tax audit. These are the two adjustments. These are the changes in. So this is also a very significant amendment. Now we'll come to income escaping assessment and search assessments. This will take a little bit of our time because all the time, particularly people who are in practice for more than 3 decades, 4 decades, we have got used to that reassessment. Section 147 is by heart for us. If the assessing officer has got reason to believe that income has escaped assessment, he could recompute the income, make a reassessment. Then all these things we know by heart because we have read it so many times. But now that old 147, power to reopen, has been removed and replaced by another one. Now, the concept of reason to believe has been done away with. Reason to believe was such an important thing for all of us. He cannot reopen an assessment just by rumor or hearsay. It should be based on some material information. But now what they have done is, assessing officer may assess or reassess income, recompute loss for the relevant assessment year. And what they say is, information which suggests income has escaped assessment. See, where is reason to believe? Where is this concept? Income which suggests, information which suggests that income has escaped assessment. They could issue a notice, but they have put some safeguards. I'll explain. Kindly wait for some time. I'll go through the entire, group of sections. Then you'll understand the safeguards in the new provision also. What they have done here is, if they want to reopen the assessment under 147, in the earlier law, in the current law, there is also another thing which they are done away with. If the failure to, if they want to reopen beyond 4 years, if they want to reopen beyond 4 years and up to 6 years, if they want to reopen beyond 4 years, that's enough. Then the failure to disclose of material facts must be substantiated. There should be a concealment on the part of the SSC under the present law. This also they have done away with. So these two crucial things. I saw one article in the Taxman publication after this budget saying that these safeguards which were there for us has been done away with is a matter of concern for us. Yes, it's a matter of concern, but let us go through this section. Now they added one more thing in this new section 147. They said they have to issue notice under 148 for reopening the assessment. And along with the notice under 148, they have to issue a report under section 148A, new section 148A, new section has been introduced. Now, what is 148A? 148A says if the officer has got some information which suggests that income has escaped assessment, officer cannot straight away issue 148 notice and reopen the assessment. Officer has to initially issue 148A notice. Then call for the explanations, answers from the assessee, review it, conduct an inquiry, and then make up his mind whether income has escaped assessment. Then that report must be attached along with the notice under 148. In other words, instead of reason to believe which is there under the current law, here there is a sort of an inquiry, sort of a discussion with the SSC, calling for information, getting confirmation that income has escaped assessment, and gives the report along with 148 notice. To a certain extent, yes. Added to this, this inquiry under 148A is going to be made faceless, e-assessments. If that inquiry is going to be done virtual mode, and you have to submit all the documents online. Therefore, the chances of not, how to word this, practical difficulties, if I could put a very mellowed down term, very diplomatic term, I would say the unfavorable tactics which the department could adopt is done away with. Therefore, this is, but this type of 148A notice, which is a preliminary notice for reopening the assessment, is not required if there is a search or a survey. If there's a search or a survey on the SSC, then what happens is the officer can straight away issue notice under 148. But again, notice under 148 cannot be issued by the officer. He has to take the permission of the specified authority. The principal commissioner or the chief principal commissioner, they are given nothing much to explain there. You have to refer to it. They have to take the permission of the. So, in other words, the power to reopen is not given to an assessing officer. He has to take the concurrence of the senior officer. So, this is what they have done. Not only that, this initial inquiry under 148A is not required if somebody else has been raided. The SSC has not been raided. Somebody else has been raided. And during the course of raid of another person, if they found some assets, found some records, information pertaining to the SSC, then also the assessing officer can reopen the assessment without giving the preliminary notice under 148. Hope I'm making myself clear. There are three situations wherein the assessment could be reopened. Situation number one, after getting 148A inquiry from the officer. Situation number two, a search or survey conducted on the SSC, straight away the officer can issue 148 with the permission of the specified authority. Situation number three, somebody else has been raided, and in that, during the course of raid, they found some assets and documents belonging to the SSC. Then also 148 can be issued directly. So these are the three situations wherein they could issue. But the good part of it, the excellent part of it is they want to focus cost benefit analysis. They don't want to spend the time on the smaller cases. So what they have said is the assessment's time limit under 149, that was also changed. Time limit for issue of notice under 148 and 148A has 148 has been is reduced. Previously, they could reopen up to 6 years. Under the current law, they could reopen up to 6 years. Now they reduced it to 3 years. They reduced it to 3 years. So what happens is the uncertainty for some assessees who feel that their income is not fully charged to tax, and that uncertainty is for a lesser period. From 6 years, it is reduced to 3 years. It's a good thing. But at the same time, they want to focus on people who have higher income and not paid taxes on it. And therefore, they have said, if they know that they have some information that the income which has escaped assessment in the form of assets, that income should be in the form of assets, exceeds 50 lakhs for any particular year, exceeds 50 lakhs for any particular year, they could go beyond 3 years up to 10 years. They could go beyond 3 years up to 10 years. This is the provision they have made. In other words, rightly so, instead of focusing on small cases, catch hold of those people who have got concealment of income of more than 50 lakhs, and that also in the form of identifiable assets. If they have it in identifiable assets, added to this with the, pre-filled income tax return forms and pre-filled 26AS, which is coming up, the system generated 26AS, the chances of escapement of income is going to get reduced. So this is an overall change they have made. So although they said, based on information, they could reopen because of these safeguards, and the time limit for completion of assessment also has been reduced, already reduced under 153 of the Income Tax Act. For assessment, under the current law, they have time of 21 months to complete an assessment. I was surprised to read this amendment. From 21 months, they are reduced it to 12 months. Regular assessment has, and for the reassessment, they have to complete it within 12 months from the end of the financial year in which the notice under 148 was served. So the reassessment chapter has undergone a total change. If you ask me whether it will hurt the SSC, to a certain extent it will hurt. But it will hurt only for people who are having a large income. The other section of the people, in my mind, will not get affected. But at the same time, I'm not trying to belittle the importance of compliance. I always suggest and firmly believe that today's situation, either you comply or you perish. If you don't give adequate importance to compliance, then it will be very difficult for anybody to survive in this country. 10 years ago, if you ask a person in the United States of America, if he has got an interest on his SP account in America, will he disclose his income tax return? He would say yes. 10 years ago, if you ask a person in India whether he'll disclose interest, all SP accounts which he has in multiple accounts, I'm not very sure whether all of them will say yes. But today's situation, things have improved, considerably improved. All accounts, they could track it with permanent account numbers. They could track it with Aadhaar cards. They could track it with your passport, the number of days stay. I was surprised in one of the cases when we handled, wherein 5 years ago, 6 years ago, they culled out from the passport the exact number of days which the person was in India. So this type of information and big data analytics is so very effectively used by the income tax department. So this is a very important amendment on which I have spent considerable time, and we will go to the next area. A time limit for completion assessment also I explained to you. Do we have a chat box here where people are sending questions, or we'll wait till the end for the questions?
We can take some questions actually.
Okay.
Jayashree, can you share your screen?
So what I will do is I will continue with the 2 more slides, and then I will stop for some questions, or I will go through the entire presentation and we could take the questions also.
About 25 minutes it will take for question answer.
Okay. So what are you suggesting? You are not clear.
Sorry?
You are not clear. Can you explain it once again?
About 15-20 minutes it will take for question answers.
Okay.
There actually.
We'll allocate 15 minutes for that. Last 20 minutes we'll allocate for the question.
Then we will keep last 20 minutes for question answer session. Thank you, sir.
Exemptions are rather very simple exemptions. Income from affordable housing. The time limit has been extended by 1 year. You are to have completed the project, got the approval of the project by 31st March 21. Because of the pandemic, the income continues to be exempted. If you complete the project instead of 31st March 21, it is extended to 31st March 22. And one more concept. See, with all the migrant workers moving out because of the pandemic, and they are again coming back, the affordable housing becomes very significant. Therefore, in this affordable housing section, ATIBA, they introduced affordable rental project. Supposing a housing project company is going to construct a housing project and let it out on rental project, that also will be eligible for the exemption. They brought in the concept. At present, I am not very comfortable. I am not very sure about this particular provision, whether the profit on the sale of these flats will be eligible or the rental income itself will be eligible. To my mind, it looks as though the rental income will get exempted. But if that being the case, the rental income is exempted. How long? It will be exempted for years to be. All these things, there is some lack of clarity in this section. So we'll wait and see what they will do at the time of passing the bill. Second one is startup. Similarly, in startup also, they have been extended by 1 year. From 31st March 21 to 22. Nothing much to explain. Interest on loan taken for purchasing affordable residential unit. See, the value of the building should not exceed 45 lakhs. So 45 lakhs a residential unit anywhere, particularly in a city like Bombay or all, what you can get 45 lakhs. So it's not very small houses to take care of the lower income group or the migrant laborers. So if you take a loan, and if the loan should have been sanctioned before March 21, extended by 1 year. So nothing much to explain there. Now coming to business profits. Okay, this is very important. Business profits we'll explain here. Now again, because of the pandemic, real estate companies, real estate is a segment which was affected and they are trying to revive it. 43 CA of the Income Tax Act. 43 CA of the Income Tax Act. If a company which is engaged in the construction of residential units and selling it as a stock in trade, and if it is going to sell less than the stamp duty guideline value, under the current law, the tolerance limit, the variation permitted, permissible variation between the stamp duty guideline value and this actual sale price is 10%. Under the current law, it is 10%, but it is increased to 20%. It is increased to 20%. That's very important, but you have to be careful. It's not a blanket for ever to come. They say conditions. Condition number 1, if you want to get the increased tolerance limit from 10% to 20%, it should be by first allotment. The residential constructing company should sell it to the owner. It should be initial allotment. that person selling it to another person, this section is not applicable. The additional tolerance limit is not applicable. Only when it is the first allotment. Secondly, the transaction should have been completed from 12th of November 2020 to 30th June 2021. 12th June 2020 to 12th November 2020 to 30th June 2020. And third one, which is very important, third condition, if you want to get the higher tolerance limit, 3 conditions. One, first allotment, the time frame, and secondly, and thirdly, the cost, the sale price should not exceed 2 crores. Residential unit, 2 crores. I just take 1 minute of your time on a very light note, because we have been discussing very serious things. On a very light note, they have tried to explain here what is a residential unit. And there they have given a lot of credentials to our imagination. We people are capable of imagining, and therefore they are given a definition of a residential unit. I'm going to just read out the definition of explanation in 43 CA. Just take a minute of your time, read it out. What is residential unit? Because we did this, joining 2 flats, making it 1 residential unit, all these things. Some of the assessees did it. For the purpose of this section, for the purposes of 43 CA, residential unit means an independent housing unit. An independent housing unit with separate facilities. Quite surprising, they say, separate facilities for living, cooking, and sanitary requirements. There should be separate facilities, distinctly separated from other residential unit within the building, which is directly accessible from the outer door. They have given too much of credit to our imagination, which is directly accessible from outer door or through an interior door in a shared hallway, and not by walking through the living space of another household. So what we would have done, 1 big flat where the price is above 2 crores, we would have attempted to make it into 2 residential units. Now they wanted to avoid that, and hence they brought in this definition of what a residential unit is. It should be distinct and separate, and it should have separate facilities. It will be providing interesting reading if you take the finance bill and see an explanation to 43 CA of the income tax. The consequential amendment is in 56(2). Supposing the builder is going to sell it for less than the guideline value, and if they are going to treat it as the income of the recipient under 56(2), because gift from a non-relative, if a property is transferred without consideration or inadequate consideration, and the difference is more than 50,000, it will be taxable as under 56(2). They amended here also, the tolerance limit can go up from 10% to 20%. So that is a very important amendment in business profits. That one is on business profits, and second one will be on other sources. Computation of book profits. Computation of book profits is something like this. First one, adjustments for income consequent to. See, what happens here is application of the advanced pricing arrangement. When will it be applied? Income of an earlier year, the advanced pricing arrangements will be applied in the current year, and the income will be increased. If it increases the income of this year, unnecessarily you are saddled with it. Or the secondary adjustments made arising out of transfer pricing. I'm just mentioning secondary adjustments. You must take the trouble to find out what is meant by secondary adjustment. Secondary adjustment. Now, the assessee could give a claim, requisition to the department, saying that this income really pertains to the earlier years. It's not for the current year. Don't take it as the current year's book profits. Reduce it from the current year's book profits. Add it to the earlier year's book profits. Compute the income. Ask me to pay tax. I will pay the tax. They make a request for rectification. And the officer can take it for the earlier years, rectify the assessment for the earlier year, modify the book profits of the earlier year, and charge the tax of the earlier year and ask you to pay the tax. This is as far as the first two is concerned, application of advanced pricing arrangements and secondary adjustments. As far as the dividend income is concerned, dividend income previously was not chargeable to tax in the hands of the recipient. Now it is chargeable to tax in the hands of the recipient. Therefore, if it is chargeable to tax in the hands of the recipient, again taking it for book profits. So the dividend can be excluded and expenditure for dividend income should be added back. So this is also a consequential amendment made here because of the shifting of the tax on dividend income from the company to the company to the investor to share. So this is and presumptive tax is a very small thing. Whether the presumptive tax is applicable to LLC or not, because the relevant section said either individual HGF or a partnership firm. And a firm is defined under Section 2 of the Income Tax Act to include LLC. Therefore, there was a controversy whether LLC can claim the benefit of presumptive tax. Now, they very clearly clarified that LLCs are not eligible for presumptive tax. Applicability of tax audit concerning us now. Just take 2 minutes of our time to explain the applicability of tax audit. At the same time, they want to promote digitalization. They want to reduce the compliance cost of the small business people and promote digitalization. So they have put the condition which is there already. 95% of the receipts should be through the digital mode. And 95% of the expenditures, 5% of the expenditure could be by cash. 95% should be, again, expenditure also should be by digital mode. If these conditions are satisfied, the existing limit for applicability of tax audit is 5 crores. Last year, it was increased from 1 crore to 5 crores. So what happens here? In the current finance bill, the applicability of tax, provided your receipts, 95% of the receipts is through digital mode and 95% of the expenditure is through digital mode, then the limit for applicability of tax audit is increased from 5 crores turnover to 10 crores turnover. 5 crores to 10 crores. So it serves two purposes. Compliance cost gets reduced. At the same time, the digitalization is encouraged. But in the process, the opportunity of chartered accountants who are getting some tax audits in the range of 5 to 10 crores will be losing out of that benefit. So we must really get prepared to focus on higher end work and move on with that option and not to get too much work done on this loss of opportunity in this limited tax audit. This will take some time, 45-4A, and this is very significant. In fact, after I explain this, I will stop and then I will take the question answers. 45-4A. You all know, yes, you all know when this 45-4 was introduced. After the various judgments of the Supreme Court, dissolution of firm and distribution of assets to partners will not be considered as a transfer. We had this section 45.3 and 45.4 introduced, and 45.4, the existing 45.4 says, if there is a dissolution of the firm or reconstitution, the question is whether it includes the reconstitution or not. That's a different issue. Dissolution of firm and distribution of assets to partners, the market value of the assets distributed shall be deemed as the full value of consideration, and the capital gain will be computed for the firm. Now, what they have done is they have withdrawn this 45.4 and substituted with a new section. 45.4 has been substituted. Now, what does it say? A specified person. Okay, A specified person means a partner of the firm. A partner of the firm at the time of dissolution or reconstitution. Very important. At the time of dissolution or reconstitution. Is in receipt of a capital asset. The firm has given a capital asset to the partner of the firm. It will be chargeable to tax as capital gains in the assessment of the entity, the assessment of the partnership firm. And for the purpose of computation, 48 of the Income Tax Act, how to compute the capital gain? They are saying the fair market value of the asset as on the date of dissolution and when you are giving it to the partner. Capital asset. 45(4) talks only about capital asset. Fair market value minus the balance in the capital account of that particular partner, minus the balance in the capital account of that particular partner, will be reduced. And the balance will be treated as a capital gain and charged to tax in the assessment of the firm. This is a very significant amendment they have made. And very specifically, they added dissolution or reconstitution of a firm. That's why somebody has already put a question, and I will come back to the question a little later. So this is new section 45(4). What is more disturbing is the introduction of this 4A. Introduction of 4A. I am unable to digest this. I look to the participants as to how to interpret this new section 45(4A). It begins by saying, notwithstanding anything contained in 45(1). So forget about the provisions of 45(1). You must have a capital asset, you must have a transfer of capital asset. Forget about all these things. It says that money or other assets. 45(4) talks about capital asset. 45(4)A refers to money or other capital asset on the dissolution or reconstitution of a firm. Okay. The profits or gains will be chargeable to tax for the assessment of the firm in the year of receipt by the partner. In the year in which the partner receives the other asset. It could be a stock in trade. It could be any asset other than a capital asset. Or money also, cash also. And what they receive is much more than what is there in the balance of capital account. And capital account, very specifically in both the sections, 45(4) as well as 44(4)A, they have said capital account should not include any increase in the capital due to revaluation of asset or self-generated asset. If you revalue an asset and increase the capital account, that excess should not be treated as a capital account. Very specifically in 45(4) and 44(4)A, they said exclude any credit to the capital account because of revaluation. Okay. This is applicable from 1/4/21 assessment year 21/22 onwards. Now the question which was put to me yesterday through mail or WhatsApp, I got it by one of the participants in this meeting, says that there is a reconstitution of firm by only, not by retirement or by dissolution, but change in profit sharing ratio. A change in profit sharing ratio between the existing partners. This is a question put to me. I'm incidentally answering a question. The change in profit share ratio is amounts to reconstitution. If it amounts to reconstitution, and the partners whose share is increased contribute some money to the firm because he gets an additional, and the partner who loses it withdraws the money from the partnership firm. In other words, it appears to be a compensation for the reduction in the share of profits. In that case, whether it will be chargeable to tax as capital gains. Mind you, the asset transferred is not a capital asset also. That's why it begins by saying, forget about 45(1). Even if it is any other assets, even if you're going to transfer cash, the problem will apply. And it will be charged with tax. Who gets the benefit? The partner gets the benefit. But the firm has to take the brunt of it. So this is a very important thing which they have done. So from my side, for the question of discussion and debate, I'm putting this question. Absolutely, the firm is incurring losses. Firm is incurring losses, and the possibility of revival in the next 2-3 years is not very attractive. Possibility is there, but they are working hard on it. One partner retires, and one partner saying that I want something more than what is there in my capital account. And the firm agrees to give that in order to have a smooth transition process. And they give that, and it has been paid in excess of the capital. Whether after paying that money, the firm again has to pay tax on it is something which I am unable to accept. So the question which the participant asked me, it's only a change in profit sharing ratio, and whether the partner receives it, whether the firm should be subject to tax. Reading the section as on date, reconstitution would include, if you refer to the definition of Reconstitution Income Tax Act, it is not defined in section 2. It is defined in the assessment of firms chapter. And if you refer to 184 or something, if you refer to that section, it says that change in profit rate for the purpose of this section, change in profit sharing ratio will amount to reconstitution. I went into the general meaning for word reconstitution. There they very specifically mentioned general meaning also includes any change in profit sharing ratio amounts to reconstitution. Therefore, my initial reaction, to the question which was put to me, yes, it may attract 4548 and it will be subject to tax. So with this, we have a few more sections on TDS and miscellaneous provisions as suggested. Now, if somebody could filter the questions and put it across to me, or if you can open up the chat box, I will just go through the questions, and whatever is I'm able to address, I will like to address. Let me see that I completed this capital gain part of slum sale is a very small one. Slum sale is section 242C says that it should be a sale of an undertaking. The word used is sale. Therefore, there is an argument other forms of transfer will not be hit by 50B. In order to take care of this thing, they have amended slum sale definition in 242C to say instead of sale of an undertaking, sale in the form of a slum sale, they said transfer. The word sale has been substituted by transfer so that it becomes, the scope gets enlarged. Zero coupon bonds also, infrastructure debt funds, if they issue the zero coupon bonds, it's eligible for deduction. That's all about the capital gains. Okay, now you tell me. You put the questions now. We have about 15 minutes time.
Okay. You please sharing your screen so that Jayesh will yeah, thank you. Jayesh? Hello.
Yes, sir. I'm able to hear you.
I think first question he has explained. We can take second also for claiming submit proof of expenditure.
Yes, the second question for LTA is asking for is it necessary to submit proof of expenditure to employer, or it can be claimed even at the time of filing the return? You see, the present situation is the year end is not yet over, March 21. We have to wait. As on date, based on the information available as on date, there is nothing in the Act to prohibit us in claiming it in the income tax return. We could claim it in the income tax return if we have incurred some expenditure. And if the amount which is claimed is excessive, very steep, then they have the access to look into your assessments and ascertain whether you have really incurred the expenditure or not. Right now, I don't see any prohibition in claiming the LTA benefit by incurring expenditure before 31st March 21, even if you are not given it to the employer, will definitely ask for evidence. Without giving the evidence, he will not consider it for the purpose of giving exemption. But if you want to claim it in your income tax return, there's nothing to prohibit you from doing it. You can do it. Jay Shah, please explain proposed amendment 45 for charging capital gain on the partnership for reconstitution of the case file withdrawn only capital to the extent of credit balance, where capital gain is subtracted. Okay. These are questions which they have to come out with clarification, because what you withdraw from the firm, when you withdraw some money from your capital account, whether it is the profit which will be first withdrawn, or if it is going to be the original capital which is withdrawn, we will say it is the original capital. The department will say it is. So what happens? So that is the problem. Let me check. Just give me a minute's time. I will go to the next question. I'll check up whether to solve these problems, whether any guidelines could be given, as in the other sections, whether they're given here. I will check and let you know. But otherwise, these problems are bound to continue. The purpose for which this amendment was introduced, to my mind, is not going to be served. There will be confusion, further litigation, which will arise because of this section. Particularly 45.4 and 45.4a, both are amendments. Considering the other amendments which are acceptable and good amendments, this, to my mind, is really an amendment which will create a lot of problems. That is as far as the question to capital gain is attracted to the extent of share of valuation of assets of the. No, they have not given all these things. Share valuation of the assets of the firm and all, they are not given at all. They have said that if a particular asset is given to a retiring partner or on the reconstitution, asset is given, and whatever is the value of the asset which is taking is higher than the balance in this capital account. Now, the benefit is passed on to the partner, but the firm has to pay tax. Firm has to pay. Now, coming to Vijay Maliwal's question, is the ceiling limit of 36,000 per member? Yes, the ceiling is 36,000 per member, but other cap is 30% of the expenditure incurred, whichever is less. 36,000 per member of the family, or 30% of the expenditure incurred, whichever is less. Therefore, you are caught by the other limit. It's not that monetary limit of 36,000 per member. 36,000 per member or 30% of the expenditure incurred, whichever is less. So if you want 36,000 per member, just imagine the amount of expenditure you have to incur. Your house will be full of capital goods. So that will be the situation. Please share the presentation. I have already shared the presentation. That's it. Oh, you mean to say the details which I explained? Oh yes, I have no problem. But I have it in hand notes. I will send it, no problem. Ceiling is per SSC. Ceiling is per person. That's right. So it is verified. Okay. The wording in 43B suggests that the employee is never allowable. Yes, from the inception. Whether this has an impact on past assessments completed as. Okay. Mr. Jayasha, you will know, whenever there is a controversy like this, the department at the time of passing the assessments would not allow it, and they disallow it. And the matter will be pending before the appellate authority or before either the first appellate authority or the second appellate authority. If that is the case, this amendment has come, as Jayasha points it out. I also mentioned it. Is 43B never includes employee's contribution. Does not include or never to have been included. Therefore, it has got a retrospective effect. So what will happen if before the pending, if the matter is pending on appellate before authority, the department will definitely quote this amendment and they will say you are not eligible for the concession, and the assessment order originally passed disallowing the expenditure will be get confirmed. That's how it happens. But supposing the assessment has allowed this employee's contribution, it will not be a basis for reopening the assessment. I don't think they could reopen the assessment and charge it to tax now because of this amendment. But if the matter is pending, and most of the cases it will have been pending, then the appeal will be disposed of in favor of the department. Interest on public provident fund contribution exceeding on provident 2 point. Yes, sir. That's a very important question which he has asked. Pankaj Kandoy, I referred you to two sections, section 1011 and section 1012. 1011 talks about a provident fund to which the PF Act of 1925 applies, or any other notified provident fund under 1011. And public provident fund is notified under section 1011. Therefore, to my mind, public provident fund also is covered under 1011. 1012 talks about recognized provident fund. 1012 talks about recognized provident fund. Now, if you contribute, but the rules in the public provident fund says you could maximum contribute only 1.5 lakhs per annum. So two situations I could think of. You are an employee in an organization, you contribute to RPF and also contribute to public provident fund. Aggregate exceeds 2.5 lakhs. You may hit payable provisions. Or some individuals, what they do is they are not employed, they are self-employed, or they are carrying on a business. They open a public provident fund in their name. They also open a public provident fund in the name of the minor children. And from their income, they make investments in their name and the minor children name. For the sake of convenience, I will assume that this individual is having 3 minor children. So he contributes 1.5 lakhs in his PF, public provident fund, 1.5 lakhs each for each one of the 3 minor children. So totally he will contribute 6 lakhs. Then also he'll be hit. My view is he'll get hit. How about interest on such excess? Yes, for all years to come. Future years also it will. In other words, continuous. This section is not only for this assessment year. It will apply for subsequent years also. Limit not applicable to PPF. Okay.
Already explained.
Yes. Okay. That I have explained. Vijay, is it okay? What's the question? Parag Ashar has asked a question. What is that? I am not able to. Cap is per annum for PF contribution of 2.5 lakh, not applicable to PF. That's his view. He has given his view. But PPF is also coming under 1011. I have given an explanation for it. Maybe it's a debatable issue. That is my view. I guess. Hope PF contribution by employee is not. No, PF employer contribution is not included. Employer's contribution in excess of 12%. If he contributes, it is deemed to be received and charged to tax. Okay, that's overall limit. Pankaj Gada, I agree with you on the 11th question. In this case, how to bifurcate interest earned? This is what I said. No, there will be some difficulties which they anticipate. Not only that, you would withdraw some amount for your daughter's marriage or a son's marriage, or for some requirement, you could draw some money from a peer. When you withdraw, you are withdrawing out of the excess amount which you have contributed, or withdrawing from the 2.5 lakhs which you contributed. These are all doubts will come. Therefore, they put a clause in the section which says that in case of difficulties, the department will come out with clarification guidelines, and they will put it like that. So we have to wait and see. Excess application done, then can be carried forward also. Excess application. What is the charitable trust? You're talking Bhavesh Dalal. Is it charitable trust? Excess application. Have you mentioned the public pronomination also? Yes. I've clarified because 1011 when public pronoun is not there because 1.5 lakhs is limit for public pronoun, but it is coming under 1011. Therefore, I hold the view. Maybe its use could be differently. This I already done.
Now 15. Question number 15.
Yes. Go further. These are questions or any more questions?
Yeah, 16.
Most of the things are again on PF only because that is something which is of interest and importance.
Next question, 17.
Okay. So can I, with your permission, go ahead with the other things on TDS, which I mentioned, which is also equally important. Regarding 44AB, what does he want? Sanjeev Mehta?
21.
He has simply questioned regarding 44AB.
Okay, no, next. Valuation of income tax is allowed. Whether registered value is allowed, yes, no problem. Okay, next. 23. After 23.
No question, ma'am.
No question. Okay.
Okay.
Thank you.
I think
Please
question,
proceed.
sir, question number 15, have you, sir, explained? I think Jayesh was asking something on question number 15 regarding section 45.
That's what I said, no?
Yeah, right. Yeah, charging
The way it is worded, it is open for interpretation and it is not happily drafted. We are not able to, because this argument will come, definitely an argument will come. When I withdraw money from my capital account, am I drawing the excess amount which is credited, or am I drawing the original capital which I invested? It's anybody's argument. I would very firmly argue that I have drawn my, originally I put 5 lakhs as capital. I'm drawing that 5 lakhs. I'm not drawing the excess. I could argue that way. But the department will come and say, no, what you have, the profit which has been credited to your assessment, excess amount, that amount only you are drawing. So these are bound to create some difficulties. At present, I am not able to give a clear-cut answer on this, but the way it is drafted, and moreover, I personally not in agreement with this amendment for the reason the benefit is derived by the partner. The benefit is derived by the partner. Asking the firm to pay tax on it is something which is again, and not the third thing is any other asset which is not a capital asset also being brought as capital gains for the partnership firm is the third thing which I have objections for this amendment in 45(4) and 44(1).
Okay, thank you, sir.
Thank you. Okay, we have time, or we will, because it's nearing 1 o'clock. If you want me to go through the presentation of the remaining TDS and TCS which is there,
you can cover important presentation for and continue for 5 minutes or 5 to 10 minutes.
I will just do the TDS part of it and be done with it. Can we share the screen now once again?
Yes, sure. Yes, perfect.
Okay. TDS on purchase of goods. If you are going to purchase goods above 50 lakhs and the person who is purchasing has a turnover of 10 crores, I am purchasing, my turnover is 10 crores, and the supplier, I am purchasing above 50 lakhs during the year, aggregate during the year exceeds 50 lakhs, then I have to deduct tax at source. There is a tax collection at source, there is tax deduction at source. And this TDS and TDS, this is again maybe an amendment to increase compliance. But practically, I will find it, the department will find it difficult to enforce and assessees will be finding it difficult to comply with. If the person to whom I am making payment is not filing his returns, has not filed his return, for the preceding 2 years. So I must ask him the question, whenever I purchase goods from a person and I'm purchasing above 50 lakhs and my turnover is above 10 crores, then I have to ask him the question, or have you filed returns for the preceding 2 years? If he says, no, I have not filed, first of all, I must get the information. Or I do not know whether it will be on public domain. If I put the PAN number of that particular purchaser and go through the site and find out whether he has filed the return or not, if it is going to be in public domain, then it's okay. I think it should work out that way only. Then the TDS rates is double the years, or 5%, whichever is higher. Or 5%, whichever is higher. So what happens here? So this becomes a cumbersome affair. Okay. Last thing I would like to, of course, I have not gone into details. It's already getting late. So I just made a cursory remark about it. Last aspect I would like to explain is exception for filing ITR return for specified senior citizens. The finance minister, while introducing this item, in his speech, said that help the senior citizens. Now, specified senior citizens, they brought in another category. 75 years or above, resident of India. He should have income only from pension and interest on deposits from the same bank in which his pension is credited. That becomes a specified bank. See how restricted it is. It's not that all specified senior citizens can get it. He should be 75 years of age. He should draw pension. Pension should be drawn from a specified bank account. And interest on deposit from the same specified bank account. And the specified senior citizen should give a declaration to the bank. I want you to comply with this requirement. The specified bank will compute the total income of senior citizen. He should not have any other income. If he has house property income, if he has mutual fund income, if he has dividend income, he is not eligible for this exception to file the return. He has to file a return. Only you have pension income and interest from the same bank in which pension is drawn. Give the declaration to the specified bank. The specified bank will compute the total income of the senior citizen, specified senior citizen, will deduct tax at source at the rates in force, including the benefit under 87A, rebate under 87A to give, find out what is the tax, deduct the tax and remit it. Such a situation, the specified senior citizen will not be required to file a return. Otherwise, he has to file a return. Therefore, this is like an additional point which students write in the economics paper just to increase the number of points. I don't see any substantial benefits flowing to the senior citizens in this exception. Very limited scope applicable. I am conscious of the fact that I have not covered the TDS and TCS in great detail, but I only mentioned this in passing. And where this exception is provided quite surprisingly in 194P, in the TDS provision. That is, senior citizen need not file the return. It is given in 194P. If you search for it in the Income Tax Act, it is very difficult to find out. It is given in 194P. I would not like to delay your lunch any further on a Sunday afternoon. You people have taken time out to listen to me. Thank you very much. And I would only like to conclude this presentation by saying I consider that my time as usefully spent for preparing as well as making this presentation. Thank you very much for participating. I conclude by drawing your attention to a quote which I have read in a departmental store. The quote or the placard in the departmental store runs as follows. It says that to the customers, if you are happy with us, tell others. If not, tell us. I'm happy with the budget. Therefore, I'm sharing it with you. Similarly, If you're happy with the presentation which I made, you tell others. If not, you come back to me. My personal email is easily accessible. If you go to the institute website, you get it, or if you go to the directory of the institute, it is there. So in case you have any specific questions, I'll be too happy to address those. But only thing is, wait for a reasonable time for my response. Nay, 1 day or 2 days, I will definitely respond to you, to your queries. Thank you very much once again. Thank you, Seema. Thank you, Jayesh. Thank you, Krishna Kumar. Thank you, Sanjeev. I don't know whether he is there or not, but still, thank you, Sanjeev, for this wonderful opportunity. I was a little skeptical to accept this invitation because with the present priorities we have, present priority to sit and prepare for this is definitely challenging. Since Sanjeev made a request to me, I known him for a long and very close association. I said, yes, let me spend time for this. I'm glad I accepted this. I have cherished my presentation. Thank you very much. Thank you, Seema. Thank you very much.
Thank you, sir, for excellent presentation. It is very much clarity in your presentation. I now request our Deputy Convener, C.A. Krishna Kumarji, to present vote of thanks to today's speaker.
Thank you, Seemaji, for giving me this opportunity. Today's learned speaker and our past president, C.A.R. Bupathy ji, has very well analyzed clause by clause finance bill of 2021. Sir has also answered the query of all participants in a very simple and lucid language. I hope our members have been benefited after listening the analysis of the budget from you, sir. On behalf of JB Nagar CP Study Circle, I propose a hearty vote of thanks to our past president CAR Bhupati ji for such an excellent and timely presentation, and also for narrating the words of encouragement about our study circle. Thanks a lot, sir.
Thank you.
you.
Thank you. Thank you.
Thank you.